The buzz around SoFi Technologies soared when the company unveiled its second earnings report for 2023. The stock witnessed an impressive surge of nearly 20%, fueled by earnings and revenue figures that surpassed analysts' predictions. As of July 31, 2023, the stock's value had skyrocketed by an impressive 148% in the span of a year. Still, given its remarkable ascent in the first half of the year, you might be asking whether it's wise to continue investing or if the market has potentially overestimated the value of this soaring fintech bank. Join me as we dive into this today to get some answers. Knowing the potential risks associated with SoFi's lending approach is essential. SoFi operates with a lending structure known as a gain-on-sale model. In simple terms, this means that after creating loans, the company swiftly sells them off to larger financial institutions like bank holding companies rather than holding onto them and earning interest over time. However, there's a notable downside to this strategy. The risk lies in the possibility of a financial contagion disrupting the gain-on-sale loan market or adversely affecting one of SoFi's major loan buyers. Financial contagion is when a financial crisis spreads from one market or area to another. This can happen domestically and globally, leading to disruptions in financial institutions across various markets interconnected through monetary and economic systems. Financial contagions tend to surprise investors, leaving them little time to respond. If issues arise within the gain-on-sale loan market, investors might face substantial losses once the news becomes widespread. Therefore, it's crucial to consider these potential risks when evaluating the investment potential of SoFi. There's a lot that growth-focused investors can find appealing. Despite the inherent risks within the financial industry, SoFi stands out due to its impressive revenue growth and an upward trajectory in profitability. Throughout the second quarter, SoFi demonstrated a consistent double-digit growth pattern in its quarterly revenue, marking a remarkable 37% surge compared to the same period in the previous year. Moreover, the company achieved noteworthy adjusted earnings before interest, taxes, depreciation, and amortization or EBITDA margin of 16% during Q2. This figure is notably higher than the margins of 5.7% in Q2 2022 and 4.7% in Q2 2021. For context, many emerging companies utilize EBITDA to present a clearer perspective on their operational performance. EBITDA provides insights into potential bottom-line profitability by excluding non-cash expenses related to financing, accounting, and taxation. On July 31st, SoFi Technologies unveiled its results for the June 30th, 2023 quarter. The digital-first financial institution reported a solid revenue of $498 million during this period. Furthermore, reported net losses of 6 cents per share were narrower than what analysts had predicted. In the official earnings press release, CEO Anthony Noto highlighted that SoFi's membership base had surged by 44% year over year. Over the past quarter, total deposits had escalated by 26%. With this robust all-around growth, the company revised its full-year 2023 outlook slightly. SoFi also clarified that it's on track to achieve GAAP profitability by Q4 2023. Yet, even though these positive announcements briefly propelled SoFi back up to around $11.70 per share, the stock has retraced a bit to just over $8.52 per share as of August 15th. And, unfortunately, the decline could potentially continue. SoFi's performance underscores its substantial enhancement in operational profitability over recent years. Additionally, the company's management has projected achieving net income profitability based on generally accepted accounting principles or GAAP by the fourth quarter of 2023. These indicators collectively suggest SoFi's ongoing strides in financial strength and reinforce its potential as an investment choice. How did SoFi manage to achieve such impressive performance? Their secret sauce lies in their financial services productivity loop or FSPL strategy. This clever approach to financial services revolves around gaining new members and selling multiple products, all while cutting down on the costs of running their financial platform. Let's break down the critical parts of this strategy. But before we proceed, we would like to thank you for watching this far. First up, data-driven decisions. SoFi is all about intelligent choices backed by data, whether developing products or running marketing campaigns. This helps them aim their marketing efforts more accurately and develop products that match their customers' needs. Then there's personalization. They're big on giving customers personalized suggestions, tailored educational resources, and insights about personal finance. It's all about making the customer's experience better. Of course, technology plays a role too. SoFi is a fan of using stuff like artificial intelligence to automate tasks and streamline processes, which brings down the costs of running the platform. And they keep adding more products and services to the mix. Becoming a bank? Yep, that's part of their FSPL plan. They want to give their customers a broader range of options to choose from. All these parts come together to ensure SoFi delivers a top-notch customer experience. Now, how do we know FSPL's working? There are a few ways to measure that. One is to look at how their membership base keeps growing, and they're also keeping an eye on the total number of financial products and services that have been opened through their platform. It's like counting how much they've achieved in terms of products since they started. Lastly, they're keen on efficiency. You know a company's on the right track when they can do more without spending much more money. But wait, if things look so good, why are some analysts still cautious about the company? There's a little something to watch out for here. Back then, SoFi was seen as the anti-bank kind of deal. People considered it a fintech on the rise, giving it a nice, high valuation. But lately, folks are starting to see it a bit more like a regular bank. Now, here's where it gets interesting for SoFi investors. If more people start seeing it as a bank, there's a chance the stock might not hold its ground as well. The surge in SoFi stock following the earnings report shows signs of transforming into a slide, and this downward trend might persist soon. There are several reasons behind this shift. Firstly, data from FSPL indicates that about 15.5% of the stock's outstanding float had been sold short as of the earnings release day. While it's not guaranteed, there's a possibility that either speculators jumped into SoFi strongly after the robust earnings news, aiming to trigger a short squeeze, or that the crowded short side began to rush to cover their positions in response to the positive earnings report. The potential decrease in squeeze mania could help explain why the stock's value dipped and might continue to do so. Apart from the squeeze factor, considering the stock's past tendency to make significant moves post-earnings, some individuals might have purchased SoFi Technologies, intending to sell it shortly after the release. This quick profit-taking could carry on and exert further pressure on the stock's performance. Lastly, this recent substantial surge has generated renewed concerns about the stock's valuation. For instance, analysts at Keefe Bruyette downgraded SoFi on August 1st, arguing that although the company is making progress, its stock has climbed too rapidly and too far. It's possible that the market could also arrive at a similar conclusion. Despite the short-lived surge and subsequent slide in SoFi's stock, there's a bright side to consider. This situation might actually present a more appealing entry point for newcomers or those looking to increase their positions. It's possible that the factors mentioned earlier could drive the stock back to the higher single-digit range. So, why might it be a good idea to consider buying SoFi during this pullback? Well, here's where things get interesting. The moment of liftoff for this emerging fintech player is just beginning to unfold. Maintaining consistent double-digit growth in revenue and achieving positive earnings could pave the way for a return to those double-digit price levels. And here's the kicker. If SoFi's strategy of capturing affluent customers through superior service turns out to be successful, the idea of the company evolving into a significant bank itself becomes increasingly plausible. Such an accomplishment could undeniably justify a steady upward movement in the stock's price, pushing it even higher. Will this fintech find its footing and surge ahead? Let us know your thoughts in the comments. If you enjoyed this video, hit that like button and subscribe for more insightful financial updates. Thanks for watching till the end. This is Nate, and I'll see you in the next one. If you want to see more on the truth about SoFi stock, check it out in this next video.